Hi, my name is Birk. I'm an economist and I'm here to tell you why timing the market beats timing the market. A lot of new investors makes the same few mistakes. Either they're day trading, maybe they're holding out and waiting for the big dip to happen so they can shove all their money in. Maybe they're scared to purchase after a big dip because what if it falls even further? Well, today we're gonna take a look at some of these statements and to understand why the best course of action really is just staying in the market and not thinking too much about it. Let's start by making a foundation with some data. Let's look at the S&P 500 index, for instance. Now, if you had purchased it 20 years ago, you would have been looking at 10 to 11% annualized return. But what if you had missed the 10 best days? Well, instead of 10 to 11%, you would now be looking into just above 6% annual return. What if you missed the best 20 days? Well, now it's just shy of 4%. And if you missed the best 30 days of the S&P 500 index for the past 20 years, you would only be looking at 1.5% annual return. Now, is there any form of pattern to madness? And data shows that there is. 7 out of 10 of the best days on the stock market has come within 15 days of a major crash. Now, you might think, let me just wait for the next big dip then. It sounds like I can make a lot of money that way. And while in theory you would be right, let's look at if the professional investors are making any money this way. Because if there is money to be made, surely they're going to do it. Well, let's look at 2024 for instance. Data shows that 65% of all professionally managed funds did not beat the market that year. And if you extend the period to the same period we just looked at with the S&P 500 index, 20 years, 80% of all actively managed funds did not beat the general market. Okay? And if that isn't a testimony to that you and I are probably not going to be able to trade actively and beat the market, I don't know what will be. Because remember, not only are they pro, but they have large amounts of teams and they have so much data available to them. So now you're wondering, well, what is the best strategy for me then? Is it completely impossible to make money? And no, quite the contrary actually. It's very, very easy. You need to take the thought process out of it. Remember, we have human bias, so we might experience things as expensive, maybe because now something cost 110, where it cost 100 the day before, so all of a sudden it's way more expensive. But we as humans cannot really keep track of all of the new information. And information really is what drives the stock market, but that's another video for another time. If we step back into the theoretic world, how do we best simulate the market then if we cannot beat it? Well, you're gonna need a broad index. Because in the theoretic world, you would want to have a little bit of every single stock there exists. Now, that is of course not possible, so the best way to simulate it is just gonna be purchasing a broad index, maybe a few different indexes, but you're gonna want to be exposed in a lot of different sectors in a lot of different companies. So what about the timing aspect? Well, in the theoretic world, the best way to simulate the market would be to purchase continuously. So never stop purchasing, purchase a little bit every single second of the day. Of course, in reality, we cannot do this, right? We cannot spend every single moment of our day purchasing a tiny amount of stock, and there's transaction costs. So whenever you want to purchase an index or a stock, well, it's going to cost you money because someone has to go and get that stock to you. So the theoretic world and the real world doesn't really comply here. So the best way, in my subjective opinion, is going to be pick one day of the month and just invest that day, but do it always, do it consistently. Let's say that you want to invest the first of the month, right? You just get paid and now you have the money to just put in and ensure that, hey, you are actually investing as you should. If you do go for that strategy, make sure that you remove the human bias. Remember the stock we just talked about? Oh, you purchased it last month for 100, now it's 105. Let me see if I can just wait a moment. Like I'm gonna wait a few days and it's gonna be down to 100 again and I would have saved €5 or dollars or whatever currency. Is that going to be a good idea? Well, no, because remember, the stock market has a tendency of growing through time, right? Yes, it goes down and it goes up, but if you take a flat average, it's gonna grow. So you are likely to lose money that way or miss out, because if you are waiting for it to fall to 100, chances are it's 110 now, and you just wasted 5 whatever currency because you did not want to purchase now. So pick a day and just purchase the stock no matter what happens. Okay? There is, of course, a world where we could have a little bit of an emergency fund and invest on the big crashes. There's a lot of math and portfolio theory involved in that, and that is something we can look at another day. But for now, if you are new or maybe you just haven't really found any success on the stock market, pick a day and just purchase a little bit every single month. Now, you could think, and you would be sort of correct if you thought that, well, if everybody chose to purchase the first of the month, because that's when people get paid, you would have an artificially high amount of demand, which would, drive up the stock prices. So if I had waited one day to the second day of the month, I would be getting a cheaper price because the demand wouldn't be artificially high. I have looked at the data and it does not seem like this is a real problem. Because remember, you and me, we're very small fish in the entire stock market. A lot of bots, a lot of capital funds, and so much money are going in and out every single day of the time, every single day. So it's unlikely that the small people like us with like 100 euros or whatever are gonna make a difference. But if you are nervous about it, just pick another day to do it. The most important thing is just that you purchase at the exact same date every single month, right? So the 2nd or the 3rd or the 4th. And remember, the reason it's important to do it the same day is to remove human bias. If the professionals cannot beat the stock market, we are not likely to do it either. Okay, so if you want more advice on how to invest as a beginner, or maybe you just care about economic theory, send this video to a friend and help me out, and I will see you in the next one.